Hello again. Today I want to talk really briefly about permanent life insurance, whole life, adjustable life, universal life, anything that has cash value and is not term insurance in retirement. And I also want to get into long term care or end of life care and how that can be affected or how that can affect your life insurance overall. So there's a lot of stuff I want to get into in this video. I'm going to try and make it brief and break it down into a few sections. And at the end, I'm going to get into some topical solutions that you can use for structuring these things, maybe how you'd want them if you could do it with this knowledge in mind. Okay, so let's get started. And the first thing that we want to get into is funding a life insurance policy into and through retirement. Okay, so the first thing that I'll get into is just an overview of permanent life insurance. Permanent life insurance has cash value and it has a death benefit. It also has a premium. Those are kind of the three factors to take into account or to design to structure a life insurance policy for you, the consumer. And a way to look at your life insurance policy after it's already been placed in force is through something called an illustration, which is what I have up on the screen over here. Another version of what my industry would call that's more geeky and analytical for advisors is called a term called an in-force ledger. Okay, so this is something you want to obtain from your provider. So I actually own a policy offered through MassMutual for my daughter, and it's a permanent policy. And MassMutual is where I got this information here. I'm on their website. We're going to look at one of their illustrations here soon. But you want to ask, in my case, if I want to get information on my daughter's policy, I would want to ask MassMutual for an in-force ledger. It's basically a snapshot of where the policy sits today and how is it going to look, taking into account some projections into the future. It's if you're an accountant or a numbers-oriented person, it's kind of like a balance sheet, an income statement, and a cash flow statement for a life insurance policy all wrapped up into one. And what we will use this for when we're talking today is kind of down here about midway down the screen. This illustration will tell us the growth that's guaranteed in the contract. There's two parts of these illustration, a guaranteed part and a non-guaranteed part. The guaranteed part is what's going to happen, kind of worst case scenario. The non-guaranteed part is what will probably happen, but may fall a little short of. Anyway, so the growth of the cash value, the guaranteed death benefit is the second thing that you're going to find and see on the illustration. And then the non-guaranteed aspects of an insurance policy. Those are going to be in a column very close to the guarantees, but they're going to look differently because most of the time there's a guaranteed minimum on these insurance policies, and then there's a realistic case, which is their illustrative values. The other thing I want to look at next is just an example. Okay, so this is an actual in-force ledger or an illustration from MassMutual. This policy, this consumer, if they would have taken this out, this is just a sample, but if they would have taken this out, they took this out at age 22. That was the first year of the contract. The premium was just over $1,000. The cash value at the end of that first year was zero. And the death benefit is shown here on this column of $100,000. We're going to focus here on today's illustration and today's concept on these guaranteed tabs. But as you'll see over here, there's also a bunch of non-guaranteed areas on this illustration. What I want to focus on first is premiums. Most people don't really think about their premiums all that much during retirement, because most of the time when people take life insurance out, they're focused on now, meaning they're focused on what's it going to cost them today and less focused on what's it going to cost them at 65 or 70 or 60 or whatever age you so desire to retire. So most of the people that take out life insurance are focused on minimizing their cost. And when someone minimizes their cost, typically that means that they pay their life insurance premium from year one to the year they die. I would say, in my personal experience, most life insurance policies are structured this way. The consumer is planning to pay that premium until the day they die. Most of the time when I talk to pre-retirees and they actually think about that from a dollars and cents standpoint, they dislike the idea of paying a premium through retirement. Most people would rather use that premium that they were paying pre-retirement and use that for spending or supplementing their lifestyle once they get to retirement. So today we're going to give you some ideas as to how you can structure it to where you do not have to make a premium in retirement. This policy itself actually starts at year one with a premium of $1,000, and it's actually designed that at age 65, that is the last premium payment that will be made. And you can see here at age 66, under a guaranteed basis, the premium goes to zero. That is ideal, or better than paying your entire life. I wouldn't say ideal. Ideal is whatever you think is best for you. There are reasons to pay premiums into retirement. Most people just don't and don't have a desire to do so. You can change this once you've set it up. Most permanent life insurance policies allow for flexibility in your planned premium. So most of the time, if you ask for an in-force ledger, you can usually make some adjustments to either your premium, your cash value, or your death benefit. Okay. So for example, if you're making a premium payment and it's not going to be paid up at retirement and you want to keep your death benefit the same, one of the solutions that I would offer usually to people is to just dump in more money. Most of the time, you can lump sum, dump in money into a life insurance cash value. Now, not always. There are some rules that you'll want to abide by. A MEC test is something that's very important. Well, for most people, it's very important to not cross over. But you can usually dump money directly into the cash value, keep the death benefit the exact same, keep your $100,000 the exact same in this scenario, and you can have a policy that is paid up, possibly. So let's say that this premium was $750. You were going to make that premium for the rest of your life. Typically, you could put, I don't know, $10,000, $5,000, $15,000, $20,000 into this cash value column just by cutting the insurance company a check and eliminate your premium going forward. Most of the time, people don't want to put another $10,000 or $20,000 into a life insurance policy. So we usually look for another option, but that is one of the options. You could dump money directly into the cash value. You could also increase your premium for a certain number of years. So let's say you're doing this audit or policy review at age 50 and you want to retire at age 60. You could simply increase your premium for those 10 years and accelerate the time frame in which it would be paid off. Usually that's some functionality or some decisions that you would have with your current life insurance policy that could maybe enhance it and accomplish your objective. If you're closer to retirement and you don't want to take money out of your pocket, let's say you don't want to increase your premium, maybe you don't want to take a lump sum of money and dump it into the cash value, you could also consider lowering your death benefit, which would then accelerate the time frame that these premiums could stop. Okay, so let's say go back to my 750 example. Let's say this premium is 750. Let's say this death benefit is 100, right? You could probably lower this death benefit down from 100, maybe down to 75 or maybe 50, and accelerate the time period in which your policy would be paid up so that you don't require more premiums for your retirement years. I'll be honest, there's a lot of options. It's very case or client specific. So the first step is getting the illustration. The The second step is figuring out if you like your agent and you want to work with him and assessing his competence in understanding these policies. I'll be honest with you, most brokers are not heavily educated on life insurance and the options that exist inside of the structuring of these insurance policies. Most people have never been trained on this. It's not their fault. It's just how they were brought up in the career. I happen to have an odd career start, and I represented a life insurance company and their broker dealer for the first 10 years I was in this career. So I have a weird understanding of some of the guts, the inner workings of these life insurance policies. If you have questions, feel free to reach out to me and I can help out. The company itself is also a good resource. Okay. I'm not saying they're going to know all the options. And usually when I call the company, I am pulling hairs to get things out of them. They usually don't have salespeople or any service oriented people in the home office. Usually they will require brokers or agents to help with that part of the process. However, they can be very helpful as well. Adjusting the policy on an existing contract usually does not involve compensation. So usually you're going to struggle to get an advisor, a new advisor, to come in and take over and vastly help you out with these policies. I wouldn't say that's always the case. I've helped tons of people out understanding and structuring life insurance policies. It's something I kind of enjoy. I know that's kind of twisted and weird, but if you need some help, feel free to reach out. The other factor that I feel like is just as important and probably much less thought of and understood is what in the world happens if you're this guy right here and maybe even bigger numbers. Like what if this was, 500,000 and this was, I don't know, 400,000 here rather than these numbers that you have here, or 400 or 500 and 250, something like that. That would put you in a scenario where these are big numbers and it might actually have a big bearing on your financial picture moving forward. And one of the things that I encourage people to look at and to consider when they're entering into retirement is at least to have some kind of a coherent plan for what happens for your end of life care. Okay, what does this mean specifically? This means if you have to go get, go into a nursing home or go get assisted living and you need to pay for that care yourself, a lot of times people run out of money or they're forced to run out of money in order to pay for their care. Guess what? This life insurance cash value also gets spent down with all your other assets. Isn't that great? So obviously I'm being sarcastic in saying that. That stinks. This is not a protected asset when you're required to spend down your other assets to qualify for Medicaid. In other words, if you're expecting the government to come in and help pay for your end of life care, they will require that this cash value gets bled or spent down to about $1,500 of total kind of liquid assets. Okay, so this cash value is not protected from that, which is why I bring it up. Cash value is an asset that is required to be utilized before the government will come in and help pay for your care. So this to me is an incentive to have a plan. It might be an incentive to not have cash value in your life insurance policies. I think about 15 years ago, the insurance industry came out with a separate group of life insurance policies, a little bit different than whole life and adjustable life and the average normal universal life. These policies were more, originally they were called secondary guarantees built into a contract. Basically what that meant to me in a roundabout way was you can have a life insurance death benefit that eventually the cash value depletes and goes away, and you're just left with the death benefit. Okay. In my opinion, if you need to plan for long-term care or end-of-life care, those policies probably aren't as bad as what most people might think they are. Yes, it doesn't have cash value, but typically those policies are cheaper when you're paying those policies all along the way, again, because you're not building as much cash value. That's not your primary focus. And then when you get to retirement, those policies typically, the cash value starts to go away and your premium typically doesn't adjust if it's structured how I would want to see it structured. So that's a solution that you could consider. Having the right kind of policy that maybe the cash value isn't there in retirement might help solve your problem. The second thing, a lot of times you can have riders on these policies that allow you to use the cash value while you're living for chronic illness or long-term care oriented needs. This is typically an additional rider. This is typically something that you would have to be underwritten for if you didn't have it on your original policy, which is maybe a reason to start thinking about this a little bit earlier. But you can typically change some things on your life insurance policy, assuming you're still healthy, and sometimes even if you're not healthy, to allow you to plan better during retirement. Okay, so what I would suggest you doing is getting your illustration, number one, figuring out what you have, and then talking to somebody that has some expertise in this area. Okay, I'm not saying that your current agent doesn't know what they're talking about. In fact, that might be where I would start most of the time. If you don't know who your agent is or your agent's no longer in the business, I'd be more than happy to help. The companies sometimes are willing to help. Typically, what you experience with these companies and these carriers are they just don't have the ability to look from a 30,000 foot view down. They typically look only at your policy and structure things only that you ask of them. So typically, in my opinion, it would be wise to get somebody like me or kind of another broker or expert that could look at this from a 50,000 foot view, look at all the stuff you have going on, put this all together, and make yourself a plan so that you can stick to it now and then into retirement as you move forward. Hopefully this was helpful. Hit me up if you have any questions. Thanks for listening.